How does an iconic brand like Birkenstock keep growing, even accelerating, in today's market? Today we're doing a deep dive into their Q3 2025 earnings. We'll pull back the curtain on how they're doing and what's next.
That's right. And we're basing this on their official earnings release and the presentation they gave, so it's straight from the source.
Okay, great. Let's get into it. The third quarter ended June 30th, 2025. What are the headline numbers? What jumps out first?
Well, the figures are really quite strong. Revenue came in at EUR 635 million.
Okay.
That's up 12% as reported. But even better, 16% in constant currency, so taking out those exchange rate effects.
16% constant currency growth, that's solid.
It is. And, the net profit story is even more striking. It surged 73% to EUR 129 million.
Wow, 73%.
Yeah, up from 75 million the year before. A massive leap.
That kind of profit jump, that's really something for a brand this size. It suggests they're running things very efficiently. What about profitability metrics?
Exactly. Their adjusted EBITDA, which is, a good measure of core operational profit,
Yeah.
that grew 17% to EUR 218 million.
Okay.
And the margin improved, too. The adjusted EBITDA margin went up to 34.4%. That's a gain of 140 basis points, or 1.4 percentage points.
So better margins, better profits, a really strong quarter.
Absolutely.
But, one good quarter is one thing. What about the outlook for the rest of the year? Are they sticking to their 2025 targets, especially with, all the economic pressures out there?
They are. They explicitly reaffirmed their guidance for the full fiscal year 2025.
Okay.
They're still aiming for revenue growth at the high end of that 15 to 17% range. Constant currency, of course.
High end even now.
Yes. And for the adjusted EBITDA margin, they're projecting between 31.3 and 31.8%. And they made a point of saying this is despite the weaker U.S. dollar, which obviously impacts them.
Right, because their earnings are euro denominated.
Exactly. So maintaining that guidance, especially the margin part, despite the currency headwind, it really signals strong underlying confidence in demand.
It really does. So for you listening, what's behind this? What's actually driving this, almost defiant growth in tricky times? How are they managing it?
Well, it looks like it's coming from a few key areas. First off, the growth is broad-based geographically, double-digit revenue growth in constant currency across all segments.
All of them.
Yep. America's up 16%, EMEA, that's Europe, Middle East, Africa, up 13%, and APAC, Asia Pacific, really leading the charge, up 24%.
24% in APAC. That's huge. So it's not just one region carrying the weight.
Not at all. It's genuinely global demand.
Interesting. Okay, beyond geography, what about the products themselves? Anything shifting in what people are buying? The sources mentioned something maybe a bit unexpected.
Yes, this is a really key insight. We tend to think sandals, right? Birkenstock equals sandals.
Mostly, yeah.
But their closed-toe shoes are actually growing faster than sandals right now.
Really?
Yeah, and that's important because it helps lift their average selling price, the ASP, what they get per item sold. The share of revenue coming from closed-toe shoes jumped by 400 basis points year over year. That's a full 4 percentage points more of their total revenue. It shows they're successfully broadening out beyond the classic sandals.
So not a one-trick pony then?
Definitely not.
Now, this next part I found really fascinating because it sort of pushes back against the whole DTC is everything narrative we hear so often. CEO Oliver Reichert actually emphasized the strength of their wholesale business, B2B, over direct-to-consumer. Why? That feels counterintuitive today.
It does feel counterintuitive, doesn't it? But his reasoning, according to the sources, is pretty clear. He calls Birkenstock a touch-and-feel product, especially for people new to the brand or maybe trying a style they haven't worn before. He pointed out they have something like 12,000 high-quality wholesale touchpoints, partner stores, boutiques.
Right, much more than their own stores.
Way more. They only have about 90 of their own retail stores. So he argues that this huge B2B network is just much more effective for getting new customers, letting them physically try the product. It challenges that idea that digital DTC is always best.
That makes sense for a product like footwear, where fit and feel are so important. Do the numbers back that up? What did the B2B performance actually look like?
Oh, absolutely. The numbers are stark. B2B revenue grew 18% in constant currency. 18%. Compare that to DTC, which grew 12% in constant currency. So B2B clearly outperformed.
Wow.
And the CFO, Ivica Krolo, added some color. He said retail revenue through their top 10 U.S. wholesale partners was up 25%.
25%.
Yeah, and up 20% through top partners in EMEA. He also stressed that B2B B2B is proving the most cost-effective way for them to reach new customer groups.
Cost-effective, too.
Right, so they actually expect B2B to keep outpacing DTC for the full year. And interestingly, over 90% of that B2B growth came from existing wholesale partners selling more, not just from opening new accounts.
Selling deeper into existing partners, that shows real strength. Okay, but if B2B is the star performer and more efficient, why keep opening their own DTC stores? They opened 13 more in Q3, right? Doesn't that seem slightly contradictory?
It's a fair question. But the way they explain it, the DTC stores serve a different kind of complementary purpose.
Okay.
Those stores, now 90 of them, are where they can showcase the entire product range, not just the bestsellers, but everything, including those higher-priced closed-toe shoes we talked about.
The full brand experience.
Exactly. It's about brand building, curation, and capturing that direct in-person demand for the broader collection. They're aiming for 100 stores by year-end and expect a quick payback on that investment, like 12 to 18 months, because transactions in those stores tend to have higher prices and more items.
Got it. So it complements rather than competes with the B2B strategy.
That seems to be the idea.
Let's switch gears slightly to brand heat. It's a bit intangible, but obviously vital for a brand like Birkenstock. How do they see that playing out? How does it connect to sales?
Well, for them, brand heat isn't just buzz. It translates into very real things like strong sales at full price, not needing discounts.
Right.
And a healthy order book looking forward.
Great.
What's really interesting is they're seeing demand grow across all product types and, crucially, all age groups. Even the icons like the Arizona and the Boston clog are accelerating, especially with younger consumers.
So it's not just us older folks wearing them anymore.
Apparently not. It's a new generation embracing them, too. Plus, they're seeing growth in newer areas like laced-up shoes and getting buzz from collaborations like that Nylon Arizona or the Maharishi Sandal collab. It keeps things fresh.
And I read they also deliberately limit production. That seems linked to maintaining that heat, creating a bit of scarcity.
Absolutely. That's a very conscious part of their strategy. They talk about maintaining relative scarcity.
Relative scarcity.
Yeah. By carefully managing production, they avoid flooding the market. This helps keep demand high, supports full-price selling, and protects the brand's perceived value. It's not about selling every possible pair. It's about keeping the desire strong. A real masterclass in brand management, you could say.
Definitely sounds like it. Okay, but it can't all be smooth sailing. What about challenges? Things like, currency swings, tariffs. How are they handling the US-EU tariff situation, for instance?
Right. They're facing those headwinds like everyone else. On the 15% US-EU tariff specifically, they have a plan. It involves some targeted price increases.
Uh-oh. Price increases.
Well, they estimate they only need a low single-digit global price increase overall to fully offset it. But it's not just price hikes.
Okay.
They're also using other levers because they make so much of their product themselves. They can look at production efficiencies, negotiate with suppliers, tweak the product mix towards higher margin items, and allocate products cleverly between regions. It's a multi-pronged approach.
So they have options beyond just raising prices for consumers. But did those price adjustments they did make actually affect demand? That's always the million-dollar question, isn't it?
It really is. But according to David Kahan, their president of Americas, the answer seems to be no. He said, quite directly, no impact whatsoever on demand since the July 1st price tweaks on some styles.
No impact whatsoever. That's bold.
It is. He even mentioned exceptional sell-throughs going into back to school. And the EMEA president said something similar. No pushback on price increases for next spring-summer, with over 90% of sales still happening at full price.
Wow, that speaks volumes about their brand loyalty and pricing power. People are willing to pay.
It certainly seems that way. The brand heat appears strong enough to absorb those adjustments.
Okay, finally, let's look at their financial health overall. How are they positioned, and are they investing for the future?
They look very solid financially. They ended the quarter with EUR $262 million in cash.
Healthy cash position.
Very. And their net leverage, basically debt relative to earnings, is improving. It's down to 1.7 times earnings. And they're aiming for 1.5 times by year end, mostly just by generating free cash flow. So the balance sheet is strong.
Good shape.
And they are investing. They spent EUR $22 million on capital expenditures in Q3, mostly on expanding their production capacity. That's a clear signal they believe demand will keep growing and they need to be ready to meet it.
Investing in more production. And didn't they also do a share buyback? That's usually a sign of confidence too, right?
Precisely. Back in May, they repurchased and canceled 3.9 million of their own shares, spending EUR $176 million.
Yep.
That does two things. It returns capital to shareholders, and it signals that management thinks the shares are a good value. It's another vote of confidence in their own performance and outlook.
Right. So pulling all this together then, the strong numbers, the B2B focus, the brand heat, managing headwinds, what's the main takeaway from Birkenstock's Q3?
I think the overarching message is one of confident and sustainable growth. It's clearly fueled by really strong consumer demand across the board globally, across products, across age groups. But it's also down to smart strategy. Their channel management, really leveraging B2B while using DTC strategically, seems highly effective. And their whole approach to brand value, that scarcity, the full price focus, the touch and feel aspect, it's clearly working.
And resilience, too, managing those external pressures.
Exactly. They're showing operational agility and the power of having such a strong brand foundation. It really looks like a blueprint for resilient growth in today's world.
It really is a fascinating story of balancing heritage with, well, staying incredibly relevant and desired. They seem to really understand their customer. What's the final thought you'd leave our listener with from this deep dive?
Well, it does raise a really interesting question for you to think about. How can Birkenstock keep balancing these two things? On one hand, their unique strategy of brand scarcity and emphasizing that touch and feel experience. On the other hand, they're investing heavily in more production capacity to meet this surging global demand.
Right. Can they keep scarcity while making more?
Exactly. Is there a tension point coming where those two goals might clash? Or have they actually figured out a way to make increased production and perceived exclusivity work together? Something to ponder.